Welcome to our weekly Forex forecast. My name is Jay Norris. I teach the art of trading at Trading University. First market we'll take a look at will be the Australian US dollar. There's Aussie USD, a little bit higher this week, and we had predicted that. We've been talking about that for several weeks, probably going on a month now. We really warmed up to Aussie when it held that support right there, and then again you saw like behavior, same retracement level there, same percentage retracement, held it there. So I definitely like that. We've been talking all along about how Aussie's been long. Aussie's a great hedge for your short euro, short Swiss currency trades. Here we'll show you our favorite here. We've been highlighting this now for probably about a month now. Aussie chief, look at that market, big blast off there. You can see our patterns there. Really, what we loved about the trade is beautiful retracement here, buying dip. That's what we do. We buy dips in essentially oversold markets where you have pretty much unsustainable fundamentals. In this case, just bullish Aussie short the chief here. We had the advantage of a huge retracement, two-third dip here on an intermediate term pattern in line with that primary pattern, and that's how those turn out. Look at that big trade, big day for us Friday, and I think you'll see some more upside here. We'll get to that in a second when we cover the Swiss franc, which is the next market we'll take a look at. Dollar Swiss, there it is, pretty good upside. Dollar Swiss, you had a late pullback Friday, a little disappointing if you're long this market like we are, core position long. On the other hand, good news for us, we feel, over the weekend. Swiss National Bank Chairman Jordan was quoted as saying, "Our goal is to reduce pressure on the franc, which remains significantly overvalued." So that would mean dollar Swiss here, dollar chief, he would be calling that significantly undervalued. So we think there's a lot of upside here. Here's the weekly chart. We think there's a lot of downside for the franc itself, a lot of upside for dollar Swiss. So we think that's what he feels. We're in agreement with that. You gotta love it when you're on the same side as central bankers. Next market, the dollar index. There's the DX. A lot of upside. You know, what can you say? This to me looks like a bull flag before you really accelerate higher. We think that the par will be the next stop, and you know, given the timing of this, you get a summer breakout like that where volumes tend to be a little thin. We could see moves accelerated here. So, you know, this may be the jump off point to 104. So we think you could see potentially 104 really by September. It's certainly in a position to do it. You certainly have the fundamentals behind it, and not only you have good sound U.S. numbers. Obviously, that unemployment number was a very pleasant surprise on the upside. Almost 300,000 jobs added, but at the same time, you just have so much uncertainty overseas right now. Clearly, the U.S. economy is the bellwether, is the leader, and we see that continuing, and we think that'll manifest itself in these long-term patterns, trends continuing. There you can see the dollar index, and you see where it came from, the momentum it had, and really you've just been pausing, been resting, now for almost 2 years. So we think it's quite normal that you'll see an acceleration out of there, and we'll see that 105 probably sooner rather than later. Next market, the euro. Really the opposite. What can you say? Europe's got its problems. Mainly its trading partners want to pull out of unions with it, want to pull out of these relationships, and that's not going to bode well for the euro. You know, we saw coming into Friday, back to that U.S. jobs number, it's bad for Europe, because if the U.S. job number is bad, if the U.S. economy goes bad, that's horrible for Europe. On the other hand, if you get good U.S. numbers, it really just tends to exaggerate the difference that you're seeing now. So we think the ECB is doing a good job of actually propping up the euro. We'd rather see it go down slowly than not, and it looks like there's where you're at now. The key right now is, this is a daily chart, so not a whole lot of data on there, but what I want you to see is that you're below the close of Brexit. So it can't rally, it's not holding its gain, so it looks like it's just going to bleed lower from here. Wouldn't be surprised if at some point you see a big acceleration down. But overall, I'd much rather see orderly sell-off in the euro, a lot more trading opportunities for us. Next market we'll take a look at is gold. As we've been saying for the past couple of weeks now, we're into buying dips in gold. As I said, just like everybody else, we think you got a shot at 1500 on the upside. On the other hand, I wouldn't be married to this position. Here's the weekly chart, and you can see you're just going to retrace the last couple of years in there. On the other hand, longer term is still in a bear market, so 1500 would be normal. That would be a 50% retracement of this bear market here. So not married to it. If I see an opportunity to buy a clean retracement, I wouldn't hesitate to do it in gold. On the other hand, it's not a core position. It's not an investment market from my perspective, the gold. Last market we'll cover will be U.S. interest rates. Here's U.S. 10-year treasuries. It's just been a blitzkrieg rally on the upside following Brexit, flight to quality into U.S. dollars, into U.S. treasuries. Take a look at the big picture here. We've covered this before. We just don't see a whole lot of upside there. U.S. debt, it's wildly popular amongst the older generations here because they're so nervous that they're just not inclined to trade the stock market. They missed out on this massive rally up in the stock market over the past 6-7 years. They're not going to jump. If they didn't jump in when it was more affordable at more advantageous levels, they're not going to jump in now. So they really have no other choice. Your mature investors other than to keep plowing money into treasuries, and that'll come to an end too, probably again sooner rather than later. But it's going to take a normalization of the global economy, not just the U.S. economy. And from our perspective, though, that's closer than you think. We think you'll have, as far as the U.S. political scene, you'll have essentially a continuation of the political parties that are running the show now. We think you'll see a continuation of that as the Democratic Party probably pretty handily holds on, pretty easily hangs on to that office, the office of the President of the United States. So we think that a continuation of the growth in the U.S. will eventually bleed into the global economy, and you'll see, well, we're more positive than not on the global economy, but it may not quite happen on the time frame everyone would like to see, but we think that good things are ahead for 2017. Between now and then, though, we think really good things are in place for the dollar, and here's what we've been calling the trade of the decade, oh gosh, all year long now. Dollar Swiss, monthly chart, plenty of upside. My name is Jay Norris. I teach trading at Trading University. Thank you so much. We'll see you next week.